Let's jump right into this definitive explainer on one of the market's premier cyclical assets, which is frankly navigating a pretty brutal macro environment right now.
We're looking at Builders FirstSource, ticker symbol BLDR. Now, you won't find the weekend DIY crowd here like you would at Home Depot or Lowe's. Instead, Builders FirstSource is literally the indispensable backbone for professional home builders, subcontractors, and modelers. They're the single largest U.S. supplier of building products and prefab components strictly dedicated to the pro market. And why does that pro market distinction actually matter to you? Well, because pros buy in massive, recurring bulk. They need bulletproof supply chains to keep complex projects on track. We aren't talking about grabbing a few 2x4s for a backyard shed. We're talking about facilitating the construction of entire neighborhoods. That makes BLDR's role absolutely critical to our national housing infrastructure. So how did management fundamentally transform this company? They pivoted aggressively away from volatile legacy materials. Historically, lumber distributors traded at really low multiples simply because of their massive exposure to the wild price swings of commodity lumber. If you remember those extreme lumber shortages and crazy price spikes over the last few years, you get exactly why that reliance is so dangerous. To escape that trap, management pulled off a massive strategic shift toward high-margin value-added products, or VAP. This includes manufactured products, think custom wall panels, prefabricated roof trusses, along with high-margin windows, doors, and millwork. Legacy commodity lumber is obviously still a necessary part of the mix, but its share of gross profit has been deliberately and steadily diluted by the relentless growth of these value-added categories. Now, this strategic pivot wasn't just about juicing margins. It actually built an imposing economic moat in what is otherwise a highly fragmented $100 billion industry. Think about how they pulled this off. First up is sheer scale. Operating across more than 40 states lets them service top national builders like D.R. Horton and Lennar with a uniform standard. Local mom-and-pop lumberyards just can't compete with that. Second is labor arbitrage, which is arguably their biggest edge. Look, if a builder can't find framers, the whole project stalls, right? They're burning money every single day. By moving framing and truss construction off the messy job site and into BLDR's automated manufacturing facilities, they directly solve the homebuilder's absolute biggest nightmare, the chronic shortage of skilled labor. And third, digital integration. Through their Paradigm software, they offer estimating and design tools that embed BLDR deeply into a builder's workflow way before a shovel even hits the dirt.
Look at this number, 99.3 million. This astonishing figure brilliantly illustrates the sheer financial horsepower of their post-COVID boom. During that era, the company was generating an immense amount of cash. But instead of reckless, undisciplined expansion, they used that free cash flow machine to repurchase a staggering 99.3 million shares. Seriously, think about that for a second. How many companies do you know that essentially bought back half of themselves in under 4 years? Since August 2021, buying at an average price around $80, they've retired roughly 48% of their total shares outstanding. Nearly half their total float was just wiped off the table, profoundly concentrating the value of the shares that are left. And as a direct result of that intense focus on value-added products, Builders FirstSource has structurally elevated its profitability floor. If you look back at the pre-2020 landscape, gross margins hovered around 24 to 25%. Driven by that strategic VAP mix, those margins soared into the mid-30s during the housing boom. But what's truly crucial for us to watch long-term is where they are right now. Even as the broader market normalizes from all that frenzy, they're holding normalized gross margins in the high 20s to low 30s, specifically hitting 29.8% in Q4 of 2025. Why should you care? Because it proves those massive COVID-era gains weren't just a fluke. The business model is fundamentally, structurally superior to what it was a decade ago. However, the narrative definitely took a harsh turn during the Q2 2026 reset. Elevated mortgage rates and severe affordability constraints really dragged down organic demand for both framing lumber and those value-added products, resulting in a sharp reality check. The mechanics here are straightforward, but honestly, pretty painful. Stubbornly high mortgage rates completely price prospective buyers out of the market. That affordability wall causes home builders to immediately pause new builds, which then directly slams BLDR's order book. The damage was obvious across the board. Revenue came in at $3.86 billion, missing consensus and dropping nearly 9% year over year. Adjusted earnings per share landed at $1.17, missing estimates by over 7%. Only adjusted EBITDA managed to squeak by in line with expectations at roughly $329 million.
So, the crucial concept to understand here is fixed cost deleveraging. As the housing starts environment weakened and organic demand dropped, operating margins compressed fast. They fell from a healthy 7.4% in Q2 of 2025 down to a heavily squeezed 3.3% in Q2 of 2026. Let's break this down simply. Think about how a factory operates. Whether BLDR is running their manufacturing facilities at 100% capacity or 50% capacity, the rent, the massive machinery costs, and the baseline overhead, they stay exactly the same. When order volume suddenly drops, those heavy fixed costs don't budge, effectively swallowing your profit margins whole. That is the brutal double-edged sword of a manufacturing-heavy setup.
Reacting to this cyclical contraction, management actually slashed their full-year 2026 revenue guidance down to $14.4 billion from a previous $15.1 billion, while simultaneously dropping EBITDA guidance to $1.1 billion. The takeaway here is stark, and it highlights a critical reality in capital markets. With earnings per share dropping over 51% year-over-year in recent quarters, it definitively proves that even the most aggressive, well-executed share buyback programs in the world simply cannot outrun a top-line cyclical contraction. Share reduction is incredibly powerful, absolutely, but it cannot invent revenue that just isn't there. Okay, let's move over to the balance sheet and see how this builds into their capital strategy going forward. Because EBITDA has contracted so significantly, leverage metrics have mechanically worsened. They've expanded from 1.5 times in late 2024 to 2.7 times net debt to last 12 months adjusted EBITDA by the end of 2025. This is a critical warning sign. For anyone holding this stock expecting the buyback machine to just continue at full speed, well, this is your reality check. While the company does still retain strong liquidity, we're talking $1.5 billion in borrowing availability and $200 million in cash flow preservation is now the absolute priority. Those massive historic buybacks we just talked about, they will absolutely have to slow down as the capital environment tightens. And this brings us to a really vital valuation reality that often trips up standard quantitative screens. Frankly, this is probably the most important takeaway if you're analyzing cyclical assets. Right now, BLDR's multiple is expanding purely because the earnings in the PE ratio, is compressing faster than the stock price is actually falling. Let's walk through the psychology of this trap. True value investors know that cyclical stocks like BLDR often appear incredibly cheap, boasting an artificially low PE ratio, right at the absolute peak of their earnings. To the untrained eye, it looks like a bargain, but it's a massive trap right before the cycle turns. Conversely, these stocks appear dangerously expensive with an artificially high PE right as they hit their earnings trough. That is exactly the phase we're approaching right now, with forward estimates implying a multiple around 13 to 15 times if management hits the revised, lowered targets. Looking at the technical price action following that Q2 miss, the stock experienced a definitive breakdown. But rather than just staring at the lines, let's talk about the actual market sentiment driving these phases. The massive multi-year blow-off top back in 2023 was driven by absolute euphoria. But that eventually gave way to a slow, grinding distribution phase in early 2026 as smart money recognized the macro headwinds and began to quietly exit. Now, we're in a clear markdown phase. The stock has sliced right through its major moving averages down to the current $66 level. Looking lower, the historical consolidation zone of $55 to $60 marks the critical support level you need to watch if this broader market downside pressure continues. Even with the short-term technical damage, we have to recognize that the underlying business continues to grind out efficiencies, essentially extracting blood from the stone. The adoption of their digital platforms creates wildly prohibitive switching costs. Once a builder is locked into that paradigm ecosystem, the friction to leave is just way too high. Plus, in a brutal macro environment like this, BLDR gets to play the role of the apex predator. As smaller, independent lumberyards struggle with higher financing costs and collapsing order volumes, BLDR has the balance sheet to step in and scoop up these prime assets at steep, distressed valuations in what is still a highly fragmented $100 billion total addressable market. Add to that the $50 to $70 million in pure productivity savings management is projecting for 2026, and you see a business actively fortifying its foundation while competitors are merely trying to survive the storm. Now, we must impartially acknowledge the immediate risks here. The absolute truth is that Builders FirstSource remains heavily tethered to the broader health of U.S. single-family housing starts. If the U.S. economy enters a broad recession and unemployment spikes, single-family housing starts could remain deeply depressed well into 2027. On top of that, we're seeing a fascinating tug-of-war within their own product lines. While the manufactured, value-added products have relatively sticky pricing, falling commodity lumber prices will continue to be a severe deflationary drag. That compresses top-line revenue and squeezes gross profit dollars on the legacy distribution side of the business. So, how should we approach this given the current environment?
By synthesizing the short-term macro pain with a highly bullish long-term structural housing deficit, which, by the way, remains completely unsolved, the definitive framework we're outlining here is a patient hold. Step 1 is exactly that, patience. Avoid a lump sum investment. Do not try to catch the falling knife immediately post-earnings. Let the institutional capital de-risk and let the dust settle. Step 2 is accumulation. If you have a multi-year time horizon, you can begin dollar cost averaging if the stock approaches that $52 to $58 range, securing a deep margin of safety. And step 3 is waiting for the conservative target of $85, anticipating a stabilization in housing starts by mid-2027 and a steady return to healthy operating margins.
Ultimately, there is a massive structural housing deficit in the United States that remains entirely unaddressed. The homes simply haven't been built to meet the demographic demand. When the Federal Reserve inevitably cuts rates deeply enough to unfreeze the market, the coiled spring of pent-up demand is going to forcefully release. Think about the pure math of this setup for a second. BLDR will enter the next housing bull market with 50% fewer shares outstanding than it had in 2021, paired with a substantially higher percentage of high-margin value-added products. The operating leverage on the way back up will be absolutely explosive. This leaves us with one final critical question to consider as we navigate this cycle. When the coiled spring of the 2028 housing market releases, will you be holding the premier cyclical asset?